Let's go through another exercise of converting GAAP to non-GAAP results. So the following GAAP-based income statement is prepared by Lemonade Stand Enterprises. For those that went through our basic accounting course, this is a familiar income statement. In addition, Lemonade Stand Enterprises provided the following non-GAAP disclosures. So not only do we have this income statement here, we also have disclosures that there is about $7 million in stock-based compensation and cost of goods sold. There's $2 million in SG&A. In addition, there are pre-tax restructuring expenses and cost of goods sold and SG&A as illustrated, $4 million in COGS, $1 million in SG&A. There is also a $12 million pre-tax loss on sale in non-operating income. So we have a net expense here. Just look at the row headers; they're identifying a net expense of which is actually $12 million in losses. There's also a $2 million pre-tax litigation gain in that same line item. So now the question is, please convert the GAAP income statement to a non-GAAP income statement. When you're ready, go to the next slide. Hit the pause button, fill out the income statement. When you're ready, hit unpause, and we're going to go through it together as a group. So let's go through this exercise. Here is the GAAP-based income statement, and then we have these non-recurring items that we've identified. So what we've done is actually very similar to the VMware style disclosures. We've actually broken out all of the potential non-recurring items in columns on top, just to make it really clear what we're adjusting to get to what is going to be a non-GAAP income statement in this column. So with revenues, there were no adjustments, so we can just simply carry over revenues. In fact, let's be a little more sort of Excel friendly with this and just link directly the revenues from before. Now, to get to cost of goods sold, there are a few adjustments that need to get made. First, we've identified that within cost of goods sold, there's about $7 million in cost of goods sold in stock-based compensation buried within cost of goods sold. We've also identified that there are about $4 million in pre-tax restructuring expenses in cost of goods sold. So let's input that here. There are no other items that are non-recurring that have been identified that are buried within cost of goods sold. And so we can just now calculate the normalized cost of goods sold as the original GAAP-based expense without these other expenses. And then the reason why we're subtracting them is because we are trying to get at what is the cost of goods sold as if these other expenses never happened. And so you have about $11 million worth of expenses within the $68 million category that are deemed to be non-recurring or not useful for the purposes of analysis. Okay. And if I wanted to make this formula dynamic, I would also actually recognize that there are no other expenses as well. So I would continue subtracting these items. Litigation gain, I need to actually switch the sign on because that's a income that I need to remove. And then the tax impact we'll deal with later on for other line items. So this is sort of placeholder formula, so I can just copy and paste across or copy and paste down. So let's move to SG&A. So SG&A, there are $2 million in stock-based compensation expense buried within SG&A, and then $1 million of restructuring expenses buried within SG&A. Nothing else, so I can just copy and paste this down. And so instead of $23 million in SG&A, I have $20 million in SG&A on a normalized basis. Now, for operating income, I can simply use a formula. 240 minus the new normalized expenses get me to 162.6. Contrast that with the original 148.6. Interest expense, there are no adjustments to interest expense, so I can just carry that over. Again, if I want it to be really good, I could just copy over the formula, which allows for there being any non-recurring items if I ever wanted to use this template again. Now, non-operating income. We've identified that there's $12 million in pre-tax losses in this net expense category and a $2 million gain. The first is due to loss on sale, and the second one is due to a litigation gain. So first thing is, let's identify that there is a loss on sale here, $12 million. And then we have a litigation gain of 2, so that's a positive. And so if we're looking at just logically at an expense category of an expense of $10 million, and we're saying ignore $12 million of expenses buried within that category and a $2 million gain, the net result is actually that category is 0. We start with an expense of 10. We're saying ignore, so exclude $12 million. So that actually ends up taking out 12 million of expenses, but then you also have a gain, which you want to add. A gain, which you want to ignore, so you want to subtract it. So you get to 0. Bottom line is we are pretending like a $12 million loss on sale never happened and a $2 million gain never happened, which means this expense category actually would show 0. And now we can just complete the calculations. EBIT minus interest expense minus this non-operating income of 0 is 160.6. Now tax expense, the final adjustment that needs to get made is we need to use the tax rate of 40% times all of these adjustments. The question is, if we didn't have stock-based compensation or restructuring charges, if we didn't have these expenses, so let's actually sum all of these sort of above the line operating expenses. Let's add up all of these. Multiply them by the tax rate. If we didn't have them, we would have had much higher taxes. By how much? Oh, got that formula. Had an extra parentheses in there. In fact, I don't really need this parentheses, so let's just make this a much cleaner formula. So I'm looking at a total of about 11 plus 3, about $14 million worth of expenses that we're saying we're going to ignore. Well, if you ignore $14 million worth of expenses, you should also ignore the fact that you were shielded from 40% of that, $5.6 million worth of taxes. If you're not going to be shielded from those taxes, let's start with the GAAP-based taxes and let's add those. That's what the GAAP taxes, that's what the normalized taxes would have been had we, for example, did not have the stock-based compensation or restructuring expenses. Of course we did, but this whole normalization exercise is somewhat of a hypothetical exercise. What if we did not have these expenses and income items that we think are non-recurring or not useful for the purposes of analysis? But then, of course, we also have the non-operating items, and I sort of separated them out just because of the different sign conventions to keep it a little bit less confusing. So if I don't have $12 million in a loss, net of a $2 million gain, so let's just sum those two, right? We're looking at basically a net loss, a net expense of $10 million. If I don't have a net expense of $10 million, I'm not shielded from taxes. This is a negative number. So what I want to do is I actually want to multiply that by a negative tax rate. Maybe an easier way to do this is to just take the minus sign and say I want to subtract the sum of these because the sign is switched. And the bottom line is that the tax impact of ignoring all these expenses, we're looking at $9.6 million worth of taxes that we would have had to pay that we didn't actually have to pay. The rest of it is just arithmetic, pre-tax income minus the tax expense, 96.4. Nothing in this case affects basic shares outstanding. So that EPS, and let me just adjust the denomination so that EPS makes sense, is $11.34. Compare that to the GAAP-based EPS of $9.64. Last but not least, EBITDA, interestingly enough, we didn't really identify what the DNA is. So for the purposes of this exercise, assume no DNA buried within cost of goods sold or SG&A just because we didn't identify it. So if we start with EBITDA of 161 and we are ignoring a whole bunch of expenses buried within these operating line items, we're looking at a normalized EBITDA of 175. Why didn't we add the non-operating, or why is it inappropriate to add the non-operating items? Well, because EBIT is earnings before interest, taxes, depreciation, amortization. These are numbers that are already after that. So EBITDA started at didn't even get into here. It started with earnings before any of these items. So we only need to adjust the operating item, the exclusions to the operating items.